Section 1. Understanding IPSAS 34. An introduction. IPSAS stands for International Public Sector Accounting Standards. These standards are crucial for governments and public sector organizations globally. The International Public Sector Accounting Standards Board, IPSAS, issues these standards. IPSAS 34 prescribes rules for separate financial statements. It applies to entities preparing individual financial statements. These statements show an entity's financial performance and position. IPSAS 34 ensures transparency and comparability in public finance. Section 2. Decoding the language key terms in IPSAS 34. Separate financial statements are presented by a parent entity, an investor with joint control or significant influence. Investments can be recorded at cost or using the equity method. A subsidiary is controlled by a parent entity. Control means governing financial and operating policies. A joint venture is a contractual arrangement with joint control. An associate is an entity with significant influence. The cost method records an investment at its purchase price. The equity method adjusts the investment to reflect profits or losses. Understanding these terms is crucial for applying IPSAS 34. They clarify how investments should be accounted for. This ensures transparency and consistency in financial reporting. Entities can provide a clear picture of their financial commitments. This clarity is essential for stakeholders to make informed decisions. It also enhances accountability and governance within the public sector. Proper application of these terms supports high-quality financial reporting. Section 3. The Guiding Lights, Principles and Objectives of IPSAS 34. The primary objective is to set out specific accounting and disclosure requirements for investments in subsidiaries, joint ventures, and associates. This applies when a public sector entity presents separate financial statements. The standard ensures clarity and consistency in reporting these investments. A key principle is the choice of accounting policy for these investments. Entities must select a policy for investments in subsidiaries, joint ventures, and associates. Options include accounting at cost, in accordance with IPSAS 29, or using the equity method. The chosen policy must be applied consistently for each category of investments. Disclosure requirements are another fundamental principle. Entities must disclose significant investments and the accounting method used. Any significant restrictions on the ability of investees to transfer funds must also be disclosed. The goal is to enhance transparency and accountability. Standardizing investment reporting improves the transparency of an entity's financial affairs. Users can better understand how the entity manages its investments and the returns derived. This contributes to better governance and accountability. Section 4. Shaping Public Finance. The impact of IPSAS 34 on public sector entities. The adoption of IPSAS 34 significantly impacts transparency within public sector entities. Many public sector organizations have complex structures with numerous controlled entities. IPSAS 34 provides a standardized framework for reporting these investments in separate financial statements. This clarity fosters greater openness and improved decision-making. Separate financial statements provide valuable information for managers and oversight bodies. They offer a precise view of the parent entity's financial performance and health. This information aids in resource allocation, performance assessment, and planning for financial sustainability. IPSAS 34 enhances the comparability of financial information. Entities ensure their financial reports can be easily compared with others following the standard. This comparability is valued by funding agencies, rating agencies, and international bodies. Clear reporting of investments leads to better accountability in the public sector. Stakeholders can assess how well the entity manages its assets and associated risks. Increased visibility drives greater accountability for public funds. This strengthens public financial management. Section 5. IPSAS 34 in Action Real-World Scenarios. Consider a Ministry of Energy with controlling stakes in state-owned enterprises. IPSAS 34 dictates how it must account for its investments in separate financial statements. Another example is a city council partnering with a neighboring council for a regional public transport system. This joint venture would be accounted for under IPSAS 34. Public universities might establish subsidiaries for research commercialization. IPSAS 34 guides how these investments are reported in separate financial statements. A national development agency or sovereign wealth fund might hold significant influence over several entities. IPSAS 34 applies to these investments, detailing the accounting method used. These scenarios illustrate the practical application of IPSAS 34. It provides clarity on financial exposure, contributions, and outcomes. This transparency is essential for stakeholders to understand the entity's financial commitments. Proper application of IPSAS 34 supports high-quality financial reporting. It enhances accountability and governance within the public sector. These real-world examples demonstrate the importance of IPSAS 34. Section 6. A comparative look. IPSAS 34 and other accounting standards. IPSAS 34 is based on IAS 27, separate financial statements. Both standards share core principles for accounting investments in subsidiaries, joint ventures, and associates. This convergence aids understanding for entities familiar with IFRS. IPSAS 34 differs from standards dealing with consolidated financial statements, like IPSAS 35. IPSAS 34 deals with separate financial statements by an individual parent entity or investor. Consolidated financial statements present the financial information of a parent and its subsidiaries as a single entity. IPSAS 34 works with other related IPSAS standards. For example, the equity method for investments in associates or joint ventures follows IPSAS 36. Investments measured in accordance with IPSAS 29 follow its rules. IPSAS 38 requires disclosures about interests in other entities complementing IPSAS 34. Many countries maintain their own national accounting standards for the public sector. IPSAS 34 provides an internationally recognized benchmark for high-quality public sector financial reporting. Adoption of IPSAS helps align national practices with global best practices. This harmonization enhances international comparability and credibility. Section 7. Weighing the scales. Benefits, challenges, and the future of IPSAS 34. The adoption of IPSAS 34 brings significant benefits to public sector entities. Enhanced transparency provides a clearer view of an entity's financial performance and position. This leads to improved consistency and comparability across entities and jurisdictions. Better quality information supports informed decision-making and accountability. Implementing IPSAS 34 can present challenges, especially for entities new to accrual accounting. The process can be complex and requires skilled accounting professionals. Valuation of investments may require specialist expertise. The initial cost of adoption, including system upgrades and training, can be significant. IPSAS 34 will continue to evolve with ongoing reviews and updates. The focus remains on high-quality financial reporting and robust public financial management. IPSAS 34 plays a vital role in preparing separate financial statements. It ensures a faithful representation of investments in subsidiaries, joint ventures, and associates. Despite challenges, the long-term benefits include improved transparency and accountability. Adoption of IPSAS 34 is crucial for sound public financial management and building public trust.